Thank you, Pascal, for a very kind and warm welcome. I was in the Czech Republic a little while ago, and I was introduced at a podium in a similar fashion, but the man introducing me read from my CV, and he said, Nitin started at Arthur Andersen, then he went to Lehman Brothers. Oh my God, let's hope CFA Institute has more luck, because Arthur Andersen and Lehman Brothers, unfortunately, did not survive, and there were some ethical lapses there. Long after I left, of course, but compared to that, it was a very kind introduction, so thank you. It's a pleasure to be in Basel. First time I'm here. Chris tells me that the sun always shines here, so I'm looking forward to coming again. But I'm impressed at seeing such a large student body. So many of you gave up the lovely day outside to come and listen to a long speech on ethics. Let me contrast that with the time that I started at CFA Institute back in 2006. And I arranged for a conference on ethics. And London, as you know, is a big financial community. Well, I was a little disappointed when only 2 people signed up. 2 people back in 2006 wanted to come and hear about ethics or discuss it or do anything with it. So it's nice to see so many of you here tonight. I hope the session will be interactive, otherwise it will be quite dull if I do all the talking and you do all the listening. What I'm hoping to do is share with you some life experiences, mainly professional, but one personal as well, where there were ethical situations or circumstances that had ethical dimensions. And I'm going to invite you to advise me as I was back then, also to share with me what you think about those ethical situations and the decisions that I made. I've deliberately selected a handful where I must admit on several occasions I wish I'd behaved differently. With the ethical maturity that I think I have today and the understanding that I have today, I think I would have behaved differently. I didn't do anything terrible, nothing imprisonable, you'll see. But nonetheless, ethical situations are often very complex. There's no obvious right or wrong. But through good analysis and deep thought, you can actually work out the right way to behave as well. So I'm hoping by sharing those examples, I'll unburden myself a little through the confessions and also get your perspective as well. So please, put your hand up if you disagree with me at any time with anything that I'm saying. If you have a point of view that you want to share, do that with us. And what I like most is when someone disagrees with me and proves me wrong, because then I walk away having learned something. If someone simply agrees with me, I learn nothing new, and I walk away as ignorant as I was before. So please, let's interact, let's try and have some fun while we're in this room and away from that sunlight. Okay, let me start with an anecdote as to why ethics is important, especially at this juncture. And it was based on something that happened to me as I was going through the airport in Washington, D.C., at Dulles Airport. I was on my way to CFA Institute's head office in Charlottesville, Virginia. And I was going through immigration when the immigration officer, looking at my passport, said, "What do you guys do? Where do you work for, CFA Institute? What do you guys do at CFA Institute?" I was a little tired, so I gave a short answer. I said, "Well, we try and raise standards of ethics." He slapped down my passport and he said, "Well, try harder." Tried much harder. I was a little shocked. I thought the young man was perhaps a little rude, but then on reflection, I decided he was right as well. The financial crisis has really eroded trust in finance and investment professionals. The average person who's a consumer of financial services doesn't think very much of us. In fact, let's take a look at a few slides that evidences that. This is a word cloud that's taken from a book titled Stewardship by John Taft. Taft argues the case for the duty of care and the burden of stewardship that people working in finance and investment have. And the word cloud represents the word association when people were asked to think of a word when they thought of finance professionals. And the bigger the word, the more frequently it occurred. So in other words, a good many people think that those of us who work in financial services, or those of us who aspire to work as investment professionals, are corrupt, greedy crooks. That's not a nice description of who you are or who you want to be, right? I hope that doesn't change your mind about your ambitions to work in financial services if you have those ambitions. Nonetheless, this is how we're currently regarded, a result of the financial crisis, no doubt. And the face of Wall Street is this. I don't know if you've seen the film, The Wolf on Wall Street. Wolf of Wall Street, sorry. If you haven't seen the film, it's a long film full of debauchery, but unfortunately based on a true story. It's entertaining to some, repugnant to others, but this has become the face of finance. Well, this is pretty anecdotal. Let me point to some better evidence as to what people think of us. This is a survey that CFA Institute did last year together with an outfit in the US called Edelman Trust Barometer. And a large number of people were asked whether they trust these industries to do the right thing. And you can see that the technology industry was the most trusted, and financial services right at the bottom. It was exactly the same in 2012 and 2014 as well. Again, the outcome of the financial crisis. So this is no longer anecdotal. This is actually empirical, asking a lot of people cross-sectionally. And then we also asked our members. We have close to 120,000 members around the world. And we asked them what they thought contributed the most to the current lack of trust in the finance industry. And they pointed to one factor above it all. You may not be able to read the axis on the bottom line, but the factor with the biggest bar, with between half and two-thirds of the people responding that way, said that there was a lack of an ethical culture within financial services. So this is how we're all seeing. Are you sure you still want to become finance professionals? Let me, just to round home the point, I'm going to show you a video clip as well. Again, more of how we're perceived.
Yeah.
We're entering the fourth year of down stock market. Is it time to sell?
Have we hit bottom yet?
What can you tell small investors who are really starting to worry?
Just this. Relax. The market goes up, the market goes down. But over the long haul, the market goes up. Yes?
Is there any chance that stocks might rebound this year?
I'm really the wrong guy to ask. I got completely out of stocks in late '99, and I haven't followed the market since.
You got out of the market 3 years ago?
Yes. You see, around that time, we at Global Century became convinced that stocks were headed for a crash, and that bonds were the safer bet. And we were right. My own bond portfolio is up nearly 30%.
But if you were moving out of stocks and into bonds 3 years ago, why were your brokers telling people like me to do the exact opposite?
Well, obviously, if you think, as we did, that stocks are heading down, and you want to unload them before a crash, you have to convince somebody out there to buy them. That's just common sense.
Yeah. Back in the summer of 2001, I wanted to move money into some defense-related and home security stocks, but your brokers talked me out of it. Is that because you and your friends were buying those stocks and wanted to keep the price down?
Exactly. We felt that with the 9/11 terror attacks coming up later in the summer, that sector of the market would probably triple in value. And once again, we were right.
You knew in advance about 9/11?
Basically, yes.
So earlier when you said you didn't own any stocks, that was a lie, right?
Correct. That was a lie. Yes.
Hi. Like a lot of us here, I followed your broker's advice, and over the last few years, I've lost 80% of my life savings.
That does not surprise me at all.
I'd just like to say that even though I think you're an evil person, and even though I came here intending to kill you, I've been really impressed with your honesty. Your kind of straight talk is rare in today's business world.
Thank you. At Global Century, we like to be completely upfront with our clients. That's why in our prospectus, we clearly state that our investment advice is often self-interested or deceitful and may work to a client's disadvantage. We think you deserve to know that.
For straight answers to your investment questions, stop by our offices for a free consultation.
Yes.
It doesn't say that in the prospectus.
Sure it does.
No, it doesn't.
Yes, it's in there. You have to read it.
I read it. It's not in there.
You're right. It's not in there. I just assumed you never read it.
I appreciate your honesty.
You bet.
Global Century Investments. Fine questions, straight answers.
It hurts to laugh, doesn't it? It's clearly a spoof. I downloaded it from YouTube a couple of years ago. It's been taken off, I think. I was looking for it again on YouTube. I couldn't find it. But I thought it was funny enough and made the point better than I could. So I think I probably convinced you that we suffer from an image problem in financial services. We may have earned it through the financial crisis, and we all need to pay attention to regaining that trust by becoming more ethical. And what I'm hoping to do over the next hour or so is just share, as I said, some examples from which we can draw some conclusions and perhaps walk out of here being a little more introspective as well. Now, because of the bad image problem, there's no shortage of advice, of course, and we have this quotation from Christine Lagarde, who's the managing director of the IMF, and Lagarde said, we need financial firms to take values as seriously as valuations, and culture as seriously as capital. We need to ingrain a greater social consciousness, one that will seep into the financial world and forever change the way it does business. So, wonderful words, but we need more than sound bites and platitudes. We really need to understand the nature and the process for ethical decision making. Now, there are many approaches to thinking about ethics, and I've listed some here, just to give us some context and perspective. First of all, there's an approach that's often termed meta-ethics. So a lot of what Greek philosophers did was meta-ethics. They thought deeply about the meaning of goodness. What do we mean by good? What's the semantics of that word? What is it in our nature? Why is it that we define certain things as good as opposed to bad? So that's meta-ethics. Then there's normative ethics, and that defines behavior. And professional associations like CF Institute take this approach. They come up with codes of ethics and behavior, standards of conduct, and so on. So normative ethics aims to guide behavior of groups of people such as investment professionals. Then there's applied ethics, which focuses much more on applying, as the name implies, applying the ethical construct in practice. Then there's descriptive ethics that takes an empirical approach and looks at how people individually and in groups actually behave. And then prescriptive ethics, which looks at what ethical advice would be helpful. So lots and lots of approaches. I just listed a few. Hopefully we will focus on a variety of these, especially the applied and the prescriptive parts, and perhaps some introspective ethics as well, where we'll learn to think more deeply about the nature of ethical dilemma. So with that as a backdrop, let me start on my 6 examples, my 6 confessions, if you like, or 6 anecdotes. The first one actually involves me and my son in a store. It was just before Christmas a few years ago. My son was 13 years old, and we were looking for Christmas gifts for friends and family. And suddenly he said, "Look, Dad, look over there." And what he saw was this. He saw a couple of iPods, so it's 2 sets of iPods. So this was a few years ago, as I said. Hardly anyone has iPods anymore. But he saw these 2 iPods, and the white ones were priced at £99.99. And then, right next to those white iPods, he saw some black iPods, equally shiny, equally new, priced at £9.99. And he said, "Look at that." So what do you think happened? Why were those prices different? Anyone? If you were in the store and saw those prices, what would you think? Yes?
The demand is just different.
So perhaps no one wants black iPods. Everyone wants white iPods because it's more fashionable, and demand for black iPods is so low that they can sell it at 1/10 of the price. Perhaps. What else might have happened? Anyone? This has never happened to you? Okay.
The one on the left-hand side is maybe not original, and it's a fake model, and the one on the right-hand side is the original one.
Okay, it could be. So they look the same, but they're not. In fact, the left one is a fake or not an original or somehow inferior, and therefore price matches it. Yes?
Maybe it's just a mistake on the price tag.
Yes, that's right. And we've all come across this before as well, right? So very likely, when you see prices of similar goods that are so different, is usually a mistake. Someone has to stack those shelves, someone has to price these goods, and what seems to have happened is a 9 got left off. Instead of someone punching in 99.99, they punched in 9.99. Okay, so imagine you're there. There are 10 black iPods that are equally in demand as the white ones, equally new. Okay, what would you do? Don't be shy. You just stand there, silent. What would you do? Anyone? Anyone? Yes?
Probably buy the black one and sell it somewhere else.
You see an arbitrage opportunity. You're a potential prop desk trader at an investment bank. You see that something seems to be mistakenly mispriced, and you can take perhaps advantage of that. You can buy it at that price and then perhaps sell it. But what if, would the storekeeper sell it to you at that £9.99?
Probably not.
But what if...
Maybe he has to, I don't know.
And that's what I asked my son. I said, son, do you think the storekeeper will sell you at that price? He said, Dad, don't worry. Mom tells me that UK law requires him to sell it to us. It's an invitation to treat. It's part of the contracting process. She told me on an earlier occasion that if anything is mispriced, you can actually ask for it at that price. So I think we're good on that. I think the storekeeper has to sell it to us. So what would you do at that point? Well, I suggested to my son that he tries to think of what the storekeeper would feel if he tried to take advantage of it. I said, how would you feel if you were the storekeeper and some customer came in and tried to take advantage of your mistake? How would you feel? And my attempt as a parent was to try and teach him the art of empathy, to think of the other, not just for himself, to think beyond the arbitrage opportunity that he had clearly seen. In fact, he pointed out to me already that, Dad, I think I can sell the black iPod on eBay at half the price, at $49.99. I can make a margin of £40 for every single unit. Give me your credit card quickly. We can make £400 out of this. So when I told him that he ought to think of the storekeeper and what would he like to do then, well, he thought for a while. He was obviously disappointed. He walked over to the checkout counter, and he told them about the mistake that had been made. And he came back to me, not totally pleased, still conflicted. Though on the one hand, he'd given out £400. On the other hand, he probably had a feeling that he did the right thing, or what his dad expected, perhaps. So, a trivial example, perhaps. There was certainly the opportunity of behaving in a certain way, but there were many different ways of looking at it as well. And straight away you identified the arbitrage opportunity. I'm sure many of you also identified the opportunity of doing the right thing as well, being fair to the storekeeper as well. But that raises the question, how do you see yourselves? Sitting here as students, you're studying for an exam, you're going to get a master's degree at some point related to finance, and perhaps many of you hope to be finance professionals. Why are you doing this? Why are you educating yourself? Is it to give yourself an advantage in getting a job? Is that what it's about? Perhaps then you could work for some big shot investment bank, make a lot of money. Is that the point? Is that the reason you're here? Is that how you're thinking of the situation, the opportunity? Are you thinking instead also that in the process you might help society at large, you might actually be useful as finance professionals? That it's not just about you, even while you're earning money, perhaps you might actually help the customers that you serve. Hopefully you're thinking a little bit about both of them. And many ethical dilemmas are a mix of motives and intentions that are presented. But let's just pause a little longer on this rather simple example of something that happened to me. Let's just think about the stages that my son went through. First stage in a situation like this is becoming aware of the ethical dilemma. Now, it was obvious that when my son saw the opportunity and asked me for the credit card, he didn't see this as an ethical situation. If he didn't see it as an ethical situation, he couldn't resolve it with any moral factors or anything in the way that it actually resolved itself. He simply saw this as an opportunity to make money. Some good fortune landed at his feet. So the first stage is the identification of an ethical dilemma. Next, he had to make a judgment about the ethical dilemma when presented to him. So when I asked him to empathize, he had to make a judgment. After the judgment, he had to have an intention to do something. Because even after the judgment, he could have decided, Dad, I thought about the storekeeper, but I don't care. I want the £400. I have no intention of doing anything different. He could have decided that, right? He could have even said, it serves the storekeeper right. You're stopping me from teaching him a lesson. He's always making mistakes. He should learn to be diligent if I take advantage of him. He could have argued in a number of ways whereby he made a judgment but decided not to actually do anything or to act ethically. So you have to have the intention to act ethically, and finally there's the act of doing so as well. He walked over to the checkout counter and did the right thing. So these are normally the stages involved in becoming aware of an ethical dilemma, of analyzing it in a different way, and then responding to it in the right way as well. Be aware of that whenever you're in a situation that demands some ethical analysis, an ethical situation such as this. Another thing that matters about how an ethical situation may be resolved is the ethical intensity of the situation. Just imagine for the moment that instead of the mispricing being £9.99, if in fact this was £99 and 90p. So the mistake had been made at this point, well after the decimal point. So in fact the arbitrage opportunity was only 9 pence for every unit. Imagine that was the case. Well, my son would probably not have wanted to take advantage of that. How could you? eBay isn't perfect. He couldn't sell at the full price. Even I might have shrugged my shoulder and said, who cares? 9p difference. I'm not, there's no ethical situation here. So you see the point, that impact and potential impact on whoever the victim might be matters. If the impact is great, you might decide to behave in a certain way. If the impact is trivial, you may not. That's part of the ethical intensity. How much harm would it do to the storekeeper who is already rich from this situation? Impact matters. The other thing that matters is social consensus. Bear in mind, we're social animals. All of our norms and our ethics and what we learn as being good are usually learned from other people. Our parents, our friends, our colleagues, all sorts of other groups that we're involved in. We learn the norms and we behave accordingly based on that social consensus. Perhaps my son, when I asked him the question about how the storekeeper would feel, felt partly that social consensus. Perhaps he felt, Dad wants me to behave differently. And only then he decided what the results should be. So social consensus matters a great deal, both for ethical and unethical behavior. So once again, when you're involved in a situation that may be ethical in nature, think about the social pressures and the social norms that you take for granted. There are other factors as well. I could go through a whole list. For example, proximity is an important factor for ethical intensity as well. In other words, how close do you feel to the potential victim? Imagine that instead of taking advantage of the storekeeper, my son was in fact taking advantage of his grandmother, my mother. Well, first of all, I know he wouldn't have done so. It wouldn't have occurred to him if the same situation presented itself where he could be 400 pounds richer and my mother 400 pounds poorer, because he feels very close to his grandmother. That proximity matters. So again, there's finance professionals. If you're already practitioners or if you're going to become practitioners, think about that distance and what it does. Most jobs in finance actually places quite a distance between you and the end customer. In my almost 20 years as a fund manager, I rarely, if ever, saw my end customer. I was used to managing large portfolios which were aggregations of a lot of people's savings and wealth. So I never met the customer or a typical customer. I met lots of intermediaries perhaps, but my job involved taking these numbers as they were on a screen, large numbers with lots of digits. I looked at screens almost all day, which were monitors on various markets. So imagine how alienating a typical job as an analyst or a fund manager can become, and that distance between the end customer and yourself could be as well. So proximity matters. Think about ways of reducing that proximity. Perhaps occasionally, deliberately going to seek out your customer, to having a coffee with her or him, to understand that there's a real person there that you're trying to serve. So ethical intensity matters. And finally, framing matters as well. And I'm sure you've come across behavioral finance and the importance of framing. But in this anecdote, my son, his frame was simply one of an opportunity for arbitrage. My frame was different, about fairness. As soon as I shared my framing with him, he immediately saw that there was a different perspective, and he adopted that. So think carefully about the frame that you adopt as well. Well, that symmetry that's implied by the ethics of reciprocity that I described, and thinking of the other person as yourself, how would you like to be treated? That's often known as the golden rule. And many people, of course, have come to the same conclusion. It should be no surprise. All of us would have probably come to that conclusion left to our own devices. But there's a long history of the golden rule, going back all the way to 2000 BC, when the Pharaoh of the Middle Kingdom wrote down as some part of his laws the need to treat others as you would like to be treated yourself. Hammurabi, of course, did that slightly differently, with an eye for an eye or a tooth for a tooth kind of symmetry. The Old Testament and the New Testament said, do to others as you would have them do to you. And similarly, the Buddha, Thales, as one of the great original philosophers in Greece, and Confucius all came to the same conclusion about the golden rule and the need for the ethic of reciprocity. But now, just for a moment, think about a situation where you are not equal to the other person, but in fact you have a great deal more dominant power over them. Not only as a parent over a child, but because you have so much more knowledge and expertise and experience. You have a much stronger hand in any negotiation. Imagine a situation like that. Well, that's the typical situation a finance professional has when dealing with customers. The typical customer does not know as much about finance as you will. Just as you are in a similar situation when you go visit a doctor. The doctor knows much more about medicine than you do. You are in an inferior position, but you trust the doctor to do the right thing by you. In a similar way, when you're a finance professional and you have the upper hand, think about how you want to behave. Let's just remind ourselves of that great asymmetry. Here are some numbers from a study that was done in the US looking at financial literacy. And these were the questions that were asked to about 1,000 people, a cross-section of ages and social classes and so on. And if you've got the slides in front of you, you'll see from that what it shows is that people struggle with very basic arithmetic. 1 in 6 people can't even work out what 10% of 1,000 is. Almost half the people can't even work out if in a syndicate of 5 people they won $2 million, how to share the $2 million between the 5 of them. And only 1 in 6 people roughly can work out what their balance would be if they started off with $200 and earned interest at 10% per annum for 2 years. Given that's the reality of the average customer, the end customer, just imagine how much duty of care and obligation to be ethical that you have. And to try and reduce that asymmetry, last year at CF Institute, we came up with a statement of investor rights. We decided to list a number of rights that the average retail customer has in terms of expectations from the vendor of financial services and products. You know, the rights include that the person should be honest and competent. They should deliver advice that's independent and objective, and so on. So this was a small step towards redressing the great imbalance between the two. Okay, let me move on now to my other examples. The first one deliberately crafted, so I seem very benign and wise as a father. I gave a wise answer. The remaining examples are not so good. They don't reflect on me so well. These were situations that happened to me in my career, and I'm going to try and engage you to find out what you would have done. Let me start with, oops, now what? This related to a trading error that I made very early on in my career as a young fund manager. I was 25 years old. I just left business school, and I joined Shearson Lehman Global Asset Management. Sooner or later, by the way, anyone who works with numbers, as an analyst, as a fund manager, as a trader, will make a mistake. To err is human. As I went up through the ranks and managed more people, I knew that part of my job was regularly dealing with errors, small and large. So it's not unusual to make some sort of a trading error. Unfortunately, I made it very early on in my career, within 3 months. And the error I made was this. My boss had asked me to work out some trades, quite a simple request, and to invest $7 million in some Spanish securities. He said, just distribute the $7 million across these 10 stocks that are already in the portfolio. Keep the mix exactly as they are now. Value them currently, keep the mix exactly the same, and simply buy $7 million worth more. So fairly trivial. I went to the Reuters terminal, got the prices, worked out a trade sheet, and on the bottom I wrote to the broker, the total trade value should not exceed $7 million. I got my boss to review it, sign off on it, and I faxed, back then it was faxes, no emails, I faxed the trade to the broker who received it. Next morning the broker rang me and he said he completed my order for $35 million worth of Spanish securities. And I said, no, you got it wrong. 7 million. Do you remember I said 7 million? I wrote it clearly on the bottom of the trade sheet. He said, no, 35 million. The number of shares you asked me to buy for every single security added up to 35 million. And I said, how can that be? I looked at the price on Reuters, I looked at the 7 million, and I worked out these trades. He said, you don't know something, a convention in the Spanish market, that the prices quoted on Reuters aren't real prices. You have to multiply them by 5 times to get to the real prices. You didn't know that? No, I didn't know that. No one had told me. I was a young fund manager, 3 years into the job. My boss had forgotten when he asked me to work out the trades. He forgot when he reviewed the trade sheet. In fact, there was a strange convention, long disappeared. I won't go into the archaic history, but that was the convention. The price on the Reuters screen was not the real price, and everyone in the market knew, except people like me. So they bought $35 million worth of securities. What should I do next? What would you do next? You're me. The broker has told you that he's just bought $35 million worth of Spanish securities, and there aren't $35 million in the account. Not as cash anyway. What would you do? Yes?
And sell the difference, the
28 million?
yes, and the loss he do with that was because spread.
There might be a
because of
profit.
the price action, because of the profit, you have to share with him. So you pay him for the loss, and
The broker.
pay the broker for the loss that he's even, or with the profit. That's a special case. You cannot do a profit. You can book it as a profit because you did not a profit. It was out of market, and most of the time you do a mistake. It's not a profit. It's a loss.
Okay, so I don't know if you all heard that. First of all, the advice is that make the client account good in terms of what was intended as the trade. The client account can't take the $35 million of securities, clearly. So somehow you have to unwind the position. The excess $28 million has to be unwound in some way because the market risk shouldn't be borne by the client account. So that's step one. And I think there's probably consensus around here that that seems sensible. Clearly, even if I wanted to, I couldn't have stuffed the client account with that $35 million. Would have been wrong anyway, I wouldn't have done it. So first of all, tell the broker to sell the difference. Okay, a trading error has been made, sell that difference. Okay, so the result of that unwinding could result in either a profit or a loss because the market will move, of course. And you suggested if there's a profit, what should you do? Share that with the broker.
Yeah.
But why share it with the broker? The broker has put no money of his at risk. None of his money comes out of the broker's account. If there's a loss, will he share that loss as well? And on what basis? Is it because you think the broker is culpable? Because I did say on my trade ticket, protect me at $7 million total, and he didn't. He bought $35 million. So perhaps there's some culpability in this as well. Anyone else? What should happen? What should happen with a profit, if there is one? What should happen if there's a loss? Who should bear that? Any ideas? You will be in these positions. You will have to make decisions. You will not be able to stand on the sidelines and wait for someone else to answer. What do you do? Okay, let's imagine the broker comes back the next day and says, we made a profit of $1 million. What would you like me to do with it? What should we do with that $1 million? Various options, right? First of all, my fund, the company that I worked for could pocket it. We might have taken the loss. The client isn't to know. The client is no worse off or better off. We did exactly what we intended for the client's account, so we could do that. We could give the client the $1 million, saying, we made a mistake. It happened to be a profit. Sorry about the trading error, but it resulted in a profit. You can have it. We could do that. What's the right thing to do? What's the right thing to do when the broker says, we managed to make a $1 million profit?
Maybe put it aside and wait for the next trading error.
Yes, you could have a reserve account, a trading error account. Put $1 million in that. Sooner or later, we'll have a loss, a bigger loss perhaps. We could do that too. So we could do a number of things. We had a rule at the firm that we worked for, that if a trading error resulted in a profit, we would let the client keep it. You can defend the trading error account as well, but we decided profits go to the client. Well, there wasn't a profit. When the broker unwound the position, he rang me. He said, there's a $3 million loss, Nitin. What would you like me to do with it? Well, I had ideas about what he should do with it, but I didn't say that. What should I do at that point? $3 million loss, crystallized. It always happens that way, or usually there's a loss, because as soon as the market sniffs that someone is in a bad position, they made an error, guess what? Everyone else takes advantage of you. And that's why you end up losing, unwinding a trading error. Back then, 35 million, or even the 28 million of unwinding doesn't sound like a lot of money today, but this was the mid-80s. For the Spanish market, there was still a developing market. It had barely emerged, in fact. $28 million was a lot. It was more than a daily turnover for those stocks, list of stocks that I had. So $3 million loss, what should we do with it? You don't want to advise me, so let me suggest that you and I are partners. What should we do with it? We're business partners. What should we do with this $3 million loss? Yes?
We should book it in our bank accounts or in our fund accounts because it is operational failure.
So we should take the loss, we should put our hand in our own pockets, not the client's account, take out $3 million and say, we made an error. It's part of doing business. Too bad. Let's just give that $3 million out of our own pockets. Sure. Any other suggestions? What about that broker? Why should the broker get away with it? That's what I was thinking when I was 25. I told the broker $7 million and he made a mistake too. Shouldn't there be some shared responsibility? Because there was shared culpability. Should we suggest to the broker that we share that trading error loss? Well, that's what I did. I persuaded my boss to come along with me to visit the broker. And I said to the broker, this $3 million loss is yours. I told you not to spend a penny, not a cent above $7 million, and you did. You had a right to protect me, and you didn't. The $3 million loss is yours, and what's it to you? What do you think his reaction was? He laughed. He was a man in his middle ages, always suntanned, spent a lot of time on the golf course and on his yacht. He was always relaxed about everything. He used to smile and laugh a lot. And he laughed out loud at my suggestions. And the laugh told me that in fact it was a polite way of saying, get lost. I'm not going to share a penny of this with you. Do what you like, it's your problem. So, instead, the broker, knowing that he had a long-term relationship with my firm, instead suggested an alternative. He suggested an arrangement, a deal. He said, how about we do this? We'll take the $3 million loss temporarily, but we know it belongs to you, but we'll carry it. So you don't have to worry about any cash flow implications. And all you have to do is make sure that we earn $3 million of commission in the next 12 months. That's the deal. We'll carry the loss, doesn't have to come out of your pocket, and then over the course of a year, over a variety of accounts, you can pay us the commission back. Is that a good deal? No one gets hurt, do they? Pierre, that's Pierre Cardon, by the way. Pierre and I know each other well over many years. I feel a little nervous being here because Pierre used to be my boss's boss. Pierre is at the BIS, the Bank of International Settlements, and he was a governor at CFA Institute as well. So Pierre suggests that someone does lose. It's not victimless, this suggestion. All the clients for whom I trade with this broker may be the losers. That should be a consideration, right? It's no fault of the other clients, even though they may never get to find out. It doesn't seem like a very ethical suggestion. But what if the broker says to you, as he did with me, in fact, he said, don't worry, you normally do between $3 million and $4 million of brokerage with us anyway. We give you the best prices. All we're asking is that you do a normal level of business with us, and we will forego the $3 million in brokerage commissions that we could have earned. Isn't this a sweet deal for you? So now, does that change the complexion? Is this now a fair deal where no one will lose? Is this the right thing to do? Really, really try and imagine yourself in that position. I was in that position. You may be in a similar position, or you may have to advise someone, one of your work colleagues. What would you do? You have to make decisions. You're in the real world, let's say. You've been offered a deal by the broker. What do you do? Okay, I won't wait for any more hands up. I'll tell you what we did. My boss and I spoke with each other in a corner, and we said to each other, you know, it's a sweet deal. Of course, there's a potential conflict of interest in case we overpay commissions to this broker. But we'll make sure we don't overpay. We will scrutinize every single deal that goes to this broker. We will make sure that in fact they offer us the best price, that their commission rate is no higher than normal and no higher than the market rate. We will make sure no client loses, not a penny. And that way we'll feel good about ourselves and the whole situation will disappear in a year. That's what we said to each other. We went back to the broker and we shook hands. We did the deal. And over the next year, we made the broker good with the commissions. Paid him a normal year's commission. It turned out to be over 3 million that we paid him. Out of that, he took the 3 million. The loss was cleared. That's what actually happened. Did we do the right thing? Was that the right thing to have done? Of course, I was very tempted to resolve it in this wonderful way. I get away scot-free. No client was hurt, as far as I know. Not a single one of them. I did take the effort to scrutinize all the deals that we did with that broker. I even submitted it to other people to review it. But was the right thing done? What would you do? Imagine an identical situation happens to you. What will you do next year when you're a young fund manager, perhaps, and the broker offers you that deal? Would you take it? Perhaps it was the right thing to do. Perhaps it was, after all, why am I even questioning it? No one got hurt. Everyone did the right thing. But in the process, we did create a potential conflict of interest. As it happens, we scrutinized the deal and blah, 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 everything I told you. But what if things had changed? What if we weren't generating enough commission for this broker? Would we have been tempted to ramp up the allocation of commission to that particular broker? What if suddenly half of our clients were gone, the entire amount of money that we manage halved, and therefore we didn't have the same capacity to pay this broker the same commission as we did previous year? Would we have been tempted to channel more of the deals that way? Would we have been tempted to fool ourselves, giving him more commission? Oh, look, what a special deal, what a special advice that this broker is offering. Let's pay him more. I think a potential conflict of interest was created. I do regret having done this deal. I think if I could go back to when I was less than half my age, I think I would have gone into that corner, spoken to my boss and said to him, let's take all of this $3 million as a loss and not create the conflict of interest. I think I should have done that. I think that would have been the right thing to do, even though it seems no client was hurt. But was it the right thing? Well, fortunately now we have all sorts of regulations, unlike the mid-80s, which protect customers from biases of fund managers, biases that may lead to unfair payment of commission to brokers. We have EU regulations, MiFID 1 and 2, demands best execution within certain parameters. We have all sorts of factors that need to be borne in mind. We have policy documents and so on and so forth. So we have lots of regulations. Bear in mind, regulations are there to protect customers. Often they provide a framework for ethical behavior as well. However, you will notice, as soon as you become finance practitioners, that most industry practitioners actually hate regulation. They complain all the time. The regulators don't know what they're doing. They're fools. They're not as wise and as competent and clever as we are. They know nothing. They tie us in red tape. We hate regulation. That's what you hear all the time. Regulations are bad. These people don't know what they do. If only they left things to us. Instead, the financial industry should remind itself that there's a purpose for financial regulation. Good regulation actually ensures efficient capital allocation, it protects consumers, it reduces systemic risk. And instead of the negative responses you often find from the industry and from practitioners of lobbying and capturing the regulator, of innovating around rules and regulations, instead I wish we had more of a focus on supporting regulators with expertise and complementing them with self-regulation. So keep that in mind when you become practitioners. Let me move on to the third example, lies, damn lies, and statistics. Okay, so here, there's a whole range of things that I did as a typical fund manager, which was make choices about what numbers to show my clients in an attempt to tell the truth. But even while that intention of telling the truth and being transparent was good, what does truth really mean in the context of a complex world? So often I had to work out the performance of a group of accounts. For example, what was the performance of all of our global small cap equity accounts? You might think it's a trivial question. However, there are lots of choices involved in calculating the answer. Which accounts do you actually select to aggregate the performance for? What time period do you report the performance for? 1 year, 2 year, 3 year, 5 year, 10 year, or the period that makes you look the best? You have so many choices to tell the truth. There are so many facets for truth. There's no single answer often. So performance measurement and its explanation is often the art of fund management, unfortunately. There shouldn't be that art. Fortunately, through the GIP standards, we have certain constraints over it. We also have frequent questions about how much our products cost. And here often there's a sleight of hand by the vendors and fund managers. We often tell them the easy part. Well, according to the prospectus for this product, the management fee is only 100 basis points. That's the cost of managing your fund. Well, that's partially true, but there are many, many other costs as well. This chart, for example, shows that it's an iceberg. What's visible is not the entirety or the bulk of the costs. There are many other levels of cost as well. What do you include? What do you exclude? What do you estimate? And what if you told the absolute truth of the totality of the cost to the client, and the client became alarmed and walked away, and no client came to you? What might you do? Hopefully you'll still tell the truth anyway. So you can see how there's lots of scope for making decisions about telling the truth. Finally, once a quarter or once a month, you have to account for yourself, and someone will ask you, so, what did you do? And you often say, well, the account returned 10%. And it may be factually true, but is it useful? Should you tell the client what the relative performance was, relative to other fund managers who manage similar accounts? They may have achieved 12% or 15%. Should you tell them, in fact, I had a bad quarter, I underperformed the average? Or should you tell them that I achieved a performance of such and such, but I took an excessive amount of risk, far more than perhaps you knew? Should you also give them the risk side of the equation as well? So again, choices about risk and return and relative performance and so on. There's so much to revealing what the truth is. It had been a surprise to me that there were in fact no principles of how you communicate regularly with a client to reveal whatever that truth might be. And here are some principles of investment reporting that CFA Institute came up with recently to start a process. It will probably be a very long-term process about how we set down principles that would guide behavior about what sort of things we should tell clients. Okay, next. Go and sell, young man. So let me reveal to you another example that happened to me. By this time I was 8-9 years into the profession. I had a fair bit of experience. I was ambitious still. My cost structure had gone up dramatically because I'd become married and I now had 2 kids to support as well. I was ambitious for myself and for my family. I wanted to afford them a certain lifestyle. I wanted to do well. And my firm told me exactly how I could do well. My boss told me simply, Nitin, if you want to earn a bigger bonus, it's simple. Perform well and bring in client account. So that's what I set about to do just like every other fund manager probably does, within my own criteria of what appropriate behavior is. So one day the marketing department came to me and said, emerging markets have been doing well, Nitin, and you look as if you come from emerging markets. And it was true, I was born in Africa and I lived in India when I was young. What can you do to put together a case for an emerging market fund for us? That's what they asked me. What can you do? You're a chap who knows about markets and about emerging markets and so on. How could we make a pitch to attract more client funds into emerging markets? Because the markets are really hot, they're doing well. Don't you think we should put more of our clients' money into those markets? So that was the question. What would you do? I know the evening is wearing on, and I keep on asking you to think about these situations, but I'm trying to make light of it as we can, and trying to make you really think, and perhaps even empathize with my situation as it was back then. What would you do? The marketing department comes to you and says, can you come up with a new investment product idea? Can you come up with a case for a new investment product? Again, this will happen to you. You will have to come up with new ideas. You will want to get more clients into your ideas because you believe in them. What should you do? Should you just say, sure, let me think about that, and I'll come back to you with some ideas? Should you say, go away, I don't sell funds, I'm not a snake oil salesman, I just manage money. You bring in the money, I'll manage it. I'm not going to make up a case for you. What should you do? The marketing department came to you and said, can we think of some new funds? Anyone? Thank you.
Especially in an emerging market, it's like that you earn 20% each year and then you lose 90% in 1 week. As seen in currencies last year, as an example.
Mm-hmm.
So you have to decide in which term you are investing. And everyone is in it, it's hot, and probably it changes, and then everyone wants to get out of it, and it's difficult to get a price.
Mm-hmm.
So it goes soft to the top and then goes straight down. That's
Yes.
the problem.
So you're demonstrating a principle of proximity, first of all. It seems that the nearer the person I am, the more likely they are to ask a question. It's really difficult to reach those at the back. Perhaps you think it's easier to not ask a question. But also, you probably have looked ahead, peeked ahead to my next slide, and realized that emerging markets, in fact, are risky. But let me tell you what I did. I thought, well, emerging markets have been doing pretty well. Of course, there's risk in emerging markets. But in the long term, I think they may not be as risky as most people think. In the long term, in fact, the risk may be overestimated. But this is the long term. Everything is golden and rosy in the long term. It's a different land, a different planet. But I believed it. And so I got together with a PhD student from the London School of Economics. I put together a case for the long-term investments in emerging markets, why it made so much sense. People read my paper, they liked it so much, they invited me to Napa Valley, a beautiful part of the United States. They were major plan sponsors at the conference, and I was asked to present my work and share with them my words of wisdom. I felt on top of the work. Wonderful. I'd made a case for emerging markets. I'd enjoyed Napa Valley, and even better, Napa Valley wine, which is absolutely delicious. And everyone had applauded me. Yeah, they clapped me on the back and told me what a great argument I'd made. I came back to London that weekend, and the very following week, trouble started in Southeast Asia. Thailand was facing a current account deficit problem. People knew about it for some time. Many people, including myself, thought it would hold. It didn't. The Thai baht started dropping. Pretty soon other currencies followed suit within the region. And before we knew it, the Thai market was down 90%. The title of my paper was Emerging Market Risk. It may not be high as you think. I was clearly right, because the risk was much higher than anyone had thought. I felt embarrassed, ashamed, foolish. I looked in awe and disappointment because some of my investments were in the Thai market and in Southeast Asia and in emerging markets already. I realized that perhaps I'd been influenced by the marketing guys coming to me. Perhaps I'd been influenced by my ambition to bring in more client accounts so that I can earn a bigger bonus, so that I can pay for all the things that I would like my family and myself to have. And this constant tension between serving two masters. Oops. So, here we go. This constant tension between having to serve two masters. On the one hand, your obligations as a professional to clients. On the other hand, your obligation to an employer to make sure that the enterprise that you're working with is a going concern, that it actually makes money as well. So you constantly wear these two hats, the professional hat and the commercial hat. Now the Bible, in its wisdom, tells us that you can't serve two masters, and yet, as an employee at a financial services firm, you will have that duty to serve two masters. What will you do? Will you favor the client to hell with the employer? Well, if you do, chances are you won't get the bonuses. You may even be fired. You sell your soul to the devil, to the god of money, mammon, and say, to hell with the client. Let's do what the employer wants, and let's make sure we do anything to get the client account in. I'll earn a fed bonus, and I'll move on. What do you do? How many of you, put your hands up, I'm going to force you to interact with me. If you think that you should be fired for the client and to hell with the employer, put your hand up. Okay, if you think that you should lean towards the employer, to hell with the client. Okay, some brave and courageous souls put their hands up. You're the new wolves on Wall Street, perhaps. Most of you didn't put your hand up because I assume it's because you think neither of those extremes is the correct behavior. That there should be some balance between the two. That you need to serve both the client and you need to serve the employer as well. And that's exactly right. Ultimately, I think you need to find that right balance. But if ever you're in doubt, favor the client above your employer. You have a duty to do so. The employer likely is much richer than the client. The employer has a much more longer term over which to earn money. But we have faced this principal agent problem every time we become an employee. And you may have come across it already, I'm sure in fact you have, in your economics and finance classes. And here's a quote that summarizes it from Adam Smith, who said, managers of other people's money rarely watch over it with the same anxious vigilance with which they watch over their own. They very easily give themselves a dispensation. Negligence and profusion must always prevail. So in fact, as an employee, you have the opportunity not only to cheat the client, but also to cheat the employer by being lazy. Why be diligent in your work, right? Let's take a shortcut. To hell with the client and the employer. Let me put myself first. Let's do minimum amount of work and see if I can earn the maximum amount of bonus. So there are all sorts of potential principal agent problems. Be aware of them. An attempt to try and overcome them is another set of codes from CFA Institute. This is the Asset Manager Code, which guides asset management companies that they have certain responsibilities to their clients. And the hope is that this guidance will make the employer behave appropriately to create the right culture of ethics, which will also guide its employees as well.
Excuse me.
Yes.
Can I just ask a question? I mean, it seems all kind of straightforward to me what I read here and also on previous slides, but putting this into the context of your example now with these Asian investments in 1997. I mean, if you're telling us this and put that into this context, what would you recommend to yourself in hindsight? I mean, I understand this kind of contradiction you're building up here. On the other hand, I would say it's not necessarily a contradiction between commercialism and professionalism, at least not if you have I assume you have made a proper analysis of potential risks and returns that are possible. I mean, the Asian crisis, many people have not seen it come.
Yes.
So, of course, you feel bad having made a proposal just 1 week before. I can very much understand that. Nevertheless, against the background of having made a proper analysis, I assume you do have certain grounds to feel, nevertheless,
Indeed.
having done a professional piece of work.
Yes, otherwise you couldn't go to work
Exactly.
in the morning. Yes, no, good question. There's not necessarily a contradiction between the two, but you can see there's certainly a tension between the two. There's a need for balance between the two. So Pascal's question is, if I may call you by your first name, your question is... I've already done so.
I did the same.
So the question is...
Reciprocity, right?
So the question is, what could I have done in Napa Valley to try to balance between the needs of professionalism and the needs of commercialism? Again, let me throw the question out to you. Please, someone decide what you might do, someone who hasn't spoken already. These are real life problems. You will face them. You can't duck them for long. You may as well start practicing now. What might you do? What would you advise me to do? I'm standing there in front of the Napa Valley crowd, and my paper says emerging market risk, it may not be as high as you think. What should I say to these people? Perhaps I should balance what I tell them. Perhaps I should tell them that my analysis is very much long-term in nature. In the near term, anything could happen. In fact, emerging market risk is much higher than risk in other markets. Perhaps I should remind them of that. Perhaps also I have a duty to remind them that emerging markets have done extraordinarily well in recent years. That the potential gains, at least in the near term, may already be realized. Perhaps the balance between markets going up and markets going down, the probability of that may be that there's a greater probability that in the near term markets actually go down. Perhaps I should preface anything I would say about the long term with all of these wealth warnings, just like a health warning on a cigarette packet. Perhaps that's what I should have done. And that's exactly what I proceeded to do in every other example and case thereafter. Made sure that as best as I could, I made the audience aware of exactly what the balance was, exactly what I was saying. But nonetheless, did I always guard myself against the temptation of selling? I don't know. Who knows? We're all biased with the best will in the world. At times you would be affected. I was an active manager. I sold product at an active management fee. Did I ever tell my clients that the preponderance of academic research shows that active management cannot generate alpha? Should I have told my clients that in all probability, as bright as you think I am, and as clever as I think I am, chances are that actually I will lose money for you compared to an index fund? Should I have given that health warning every time? Do I have a duty as an active manager? Does every active manager have that duty? In fact, should the regulators demand that every single pitch made by an active manager has to make sure that there's informed consent? And if there's informed consent, it can only be so if the active manager reveals, first of all, the evidence, a huge amount of evidence against active management, and relatively smaller part of evidence, piece of evidence, in favor of active management. Should that be shown and said, now, good luck to you, make the decision. So it is hard. It's hard when your living is at stake. You fool yourself that buyer beware. Should we change from buyer beware to seller beware? should the regulator make it clear to the seller that if there's any problem, we will hold you responsible, not the buyer. We will not buy the buyer beware argument. I don't know. This is for your generation to decide. Right now, it's much more about buyer beware. Active managers do not make it clear exactly what the academic evidence, mountains of that evidence shows. Let me move on. I did all I could. This was a market timing scandal. Let me ask you to imagine a time machine. A time machine where, such as this, I don't know if any of you watched Doctor Who, which is a science fiction fantasy program with a long pedigree in the UK. Doctor Who is a Time Lord who can move back and forth in time, and he does so by going into this police box, which is cavernous inside, but from the outside it's small. Anyway, this is a time machine. Imagine you had a time machine. What would you do? What use would you put it to, given that you're all finance majors, wishing to be rich and in retirement by the time you're 30 or 35? What would you do? How would you use the time machine? But you're getting tired, I can see. Well, probably what you're thinking is, well, you would simply wait for the markets to close, see how they did, use the time machine to go back to the beginning of the day at the start of the market and put your money on either a long or a short position. Take advantage of what you've learned, right? You would simply use the time machine to hop back and forth in time to take advantage of knowledge and prescience that no one else has. Well, no such time machine exists, as we know. But back in the 80s, there did exist a time machine of sorts. And it was this. In the US, imagine you're an American citizen. You wanted to invest in an American mutual fund. The American markets in New York had closed. The mutual fund price had already been set at the close of the market. It was now well after market opening times. Well, you could still buy that mutual fund at the closing price until the New York market opened again the next morning. Why is that a time machine? Why is that any advantage? The market doesn't open again until the morning. By that time you can't, once it opens you can't trade at the previous close. But between 4:30 or whatever time it was back then when the market closed and it's opening again at 9:30 in the morning, you could trade at the close. Why is that an advantage? How would you take advantage of it if such a situation and opportunity existed for you right now? What would you do? You're an American citizen in the US. What would you do? Come on. Masters in finance, we have dozens of them here. Here's a potential opportunity. How would you take advantage of it? Yes?
Well, you watch the markets open earlier.
Which markets?
For example, in Japan. And then probably the assets traded on the New York Stock Exchange is somehow related to the performance.
Indeed. Indeed. And that's exactly right. I'm sure a lot of you were bashful but thinking exactly the same thing. You take advantage of the movements in the Far East markets. The sun rises in the east, so the Japanese market opens first, then the Far East markets open, then the European markets open, and a lot of the news, which is in real time, gets impounded in the prices of those markets. So a minute before the US market opens, you have a pretty good idea of what the US market will do, at least for a short while, most of the time. If the Far East and the European markets had roared and had been very strong, you would probably buy the mutual fund at yesterday's close. If they had tanked, you would probably sell at yesterday's closing prices, right? And that way you would do well. That was the time machine that existed. And therefore, there were a lot of market timers. Market timers who did exactly this. They moved in and out of mutual funds. They had special deals with the mutual fund platforms, so they didn't have to pay transaction fees. They could buy and sell at the closing and opening prices. So that's what they did. And they made money out of it, because of the knowledge that they gained transmitted through other markets. Does that matter? Who loses? These market timers made use of that knowledge. They bought at yesterday's close before the market opened, and they made a tidy profit. Either in a long or a short. Why does it matter? Why have I shown them as a robber with a gun in one hand and a mask over his eyes? Who loses here? Is anyone losing? Any ideas? Anyone? Surely in a zero-sum game, if someone gains, chances are someone's losing. Someone doesn't know that the market timers have a hand in their pocket. Who is it? Who is not aware? Yes?
But isn't that part of market efficiency?
It may be, and you may defend it, saying, market timers were simply responding to the news faster than anyone else. They were, in fact, doing social good. They should not be depicted like this. They should have a heel on their head. They were doing something good.
It doesn't really make a difference because there was no opening and closing times then, really. Because you would have these market timers would then just take...
So perhaps they're adding to market efficiency, perhaps, and that's an open-ended question. But who's losing? They're making money, right? You agree
sure.
that?
But I mean, it's just to opening times then you'll have others that lose.
No, but every time a market maker makes money, $1, someone has lost that dollar somehow. And so my question is, somewhere here is a protagonist behind the scenes who we're not aware of, and he or she is not aware of the fact that $1 has been taken out of her pocket by this market timer. Who is it? Who's lost the money? Well, the person who's lost the money is the existing mutual fund owner. The mutual fund owner who's not trading. The mutual fund owner perhaps who has toiled night and day, earning the money to save in the mutual fund for her retirement, and simply keeps the money there for the longer term. What happens is, by gaming the market in this way over the long run, there's a transfer of wealth from existing fund holders who do no trading to those who are market timing in this way. If the market timer had not bought at the lower closing price, at an artificially low price, but had in fact bought at a fair price which reflected the latest news, then the price would have been higher. And every time a new mutual fund holder buys, there's a new unit created at a certain price, which actually transfers wealth potentially. So I won't go into the detail, but there is a time machine existed, a market timer existed, and I was the mutual fund manager who constantly had these market timers moving money in and out of my account, and they were a pain because they kept on putting money into my account or into the fund that I managed. So I had too much money for a day or two, and then they would take it out. I couldn't even invest it. I had too much cash when I didn't want it, and I didn't have enough when I needed it. And they were a trouble to me. So I went to my legal department and said, can we stop these market timers? First of all, it doesn't make my life any easy. Second, it seems unethical. They're stealing money of the existing mutual fund holders, those who are loyal to us, those who are in it for the longer term. Can we stop them? Their answer was, no, we can't stop them. It's legal. It's the norm. Everyone's doing it. Go back to your desk and carry on. So after repeated attempts, I went back to my desk and carried on. There were a lot of people doing it. There was no law against it. There was a common practice in the US. Well, consensus changed. There were more and more complaints in the US eventually, years later. The regulator moved. In the end, they trapped, as it happened, an ex-colleague of mine from the firm that I worked at, who is now the head of marketing and sales at a major mutual fund house in the United States. And he had been foolish enough to put in an email in response to a question. He said, I hate these market timers as well. We can't do anything about them. Anyway, let's at least take the management fee for a day or two while we have their money. The regulator took an exception to him, insisted that the firm fires him for such an unethical statement, even though everyone else was doing it. And he was drummed out of not only his job, but out of the United States. He went off to South Africa for 10 years. Didn't live badly. He ended up in Cape Town, and he's back in Boston in the business. It had severe consequences for him. But the point of this was this. If you become a kind of a whistleblower, you do what you think is right. You tell your legal department, you tell your chief investment officer, your chief executive officer, and all of them say, don't worry about it, just carry on. What will you do? What options do you have? What if you faced the same dilemma that I did as a mutual fund manager? You knew there was something unethical about what was going on. You were a participant in that long chain of ultimately unethical behavior. Money was being transferred from one group of decent people to another group that was not so decent. What would you do? You tried your best, remember, to raise the alarm, to protest. You'd been told to go back to your desk and get on with your job. What would you do? How many of you, put your hand up, would have had the courage to say, you know what, I don't want to do this job. I want to walk away. You know, I don't need this job. I don't want to do it in this way. This defines me and my life. This is not what I want to do. If you cannot help me to be good in the way that I define it, that I don't want to do this activity. How many of you would have done this? Put your hand up if you think you would have had the courage. Put your hand up if you think you will do that if faced with similar circumstances. You will simply walk away from a well-paid job. Perhaps you won't be able to pay the mortgage on your house. Perhaps your wife and kids will leave you afterwards. Perhaps your life will fall apart. Who will have that courage? Well, I didn't. I didn't even think about it momentarily. I carried on. But I wish I'd done differently. I wish I hadn't given up. I wish I had the courage to speak up more and more loudly, to make more and more people aware. And if no one listened, I wish I had the courage to say, I don't need this. I don't want to do this. It's easy, perhaps at my age, being relatively financially independent, to say all of this. Of course, I was in a different position as a younger man, but I wish I had done differently. You will also be tested in a number of ways with ethical dilemma like this. Remember,
may I just ask, what exactly would you have done differently, or what, in hindsight, would you have done now?
So as I said, I would have perhaps made more noise publicly. I don't know if anyone would have heard. Perhaps I might have picked up the phone to the regulator in the US and said, stop this. This is unfair. This is wrong. Let me add my voice to anyone else who said this as well. But I didn't. And as I said, perhaps I would have walked away and said, look, if the whole system is rotten, I don't want to be party to this activity. I can earn my living. I want to earn my living in a different way. And whatever happens, let it happen. My life is bigger than this. I don't want to be polluted in this way. I could have done that. I don't know, it's easy, as I said, to wish that when I'm in a safe position now. I certainly didn't have the courage back then. I only wish I had that courage at that time. But I want you to understand that you do have these choices. And it's up to you how you make that choice. Remember, even good people can be induced or seduced or initiated to act unethically for a number of reasons. We rationalize our unethical behavior all the time. We say all sorts of things. It's not my responsibility. No one's getting hurt here. Everyone else is doing it, for example. Or I tried to change the system. Look, I tried, I have the evidence. I went to the legal department over and over again. Look, I'm a decent person. The system beat me. We say all sorts of things to rationalize unethical behavior. Beware of that. Really give yourself the hard test of being fair. Put yourself in the position of the customer or the potential customer. We're running out of time. I'm going to skip this final. Chris is laughing because I've done this presentation a number of times now. I've always run out of time. I'm way too long-winded, perhaps. So let me instead conclude and make sure you get away to your evenings and to your dinners as well. Let me conclude quickly. First of all, you need a framework for ethical decision-making. Here are some sensible questions you might ask yourself to decide what your framework should be. What are the facts? Who do you owe duty to? What are the real ethical issues at stake what ethical principles are involved, are there any conflicts, and if there are any, how can they be resolved or managed? These are sensible type of questions that you must learn to ask yourself. There are also some fundamental ethical principles at stake as well. The most simple one is put the needs of the client first. That's your professional obligation. You must take that very seriously. At all times, remain independent, be objective, avoid or manage conflicts of interest. You will come across many conflicts of interest. The real world and real life is complex. It goes well beyond the complexity you may have experienced as younger people. Real world is complex. You will have conflicts of interest. And when in difficult situations, do the most obvious things. For example, disclose fully. Be transparent. Act as fairly as you can. Divulge all the complexities and the conflicts to the other party as well, so they understand it and they trust you as a result. They understand and they empathize with you and resolve those conflicts with them fully and openly. And take reasonable care and act prudently as well. To help you guide that, try and adopt an ethical code as a professional. The easiest and simplest way is to actually become an investment professional by taking a program such as the CFA program, by earning the designation such as the CFA designation, and binding yourself voluntarily and willingly to a code of ethics, to adhere to it and to attest that you adhere to that code of ethics every year, that you have, with the best intentions, done your very best to do the right thing. Remind yourself that you've done that, declare that to the professional associations, and keep learning about new ethical dilemmas, ethical situations. Try and achieve ethical development and ethical maturities. Ethics should be taught, it must be taught, but equally ethics must be learned as well. There's no end point to being good. Life is far too much complicated for that. Continue learning about your ethical obligations and navigating a difficult situation. Let me leave you finally with a quote that I like a great deal, and it's by Mahatma Gandhi, that great fighter for Indian independence many decades ago. And Gandhi said, if you want to change the world, begin with yourself. Become the change that you want to see in the world. In other words, each and every one of us in this room, in our industry, in our society, each one of us has an individual responsibility. First of all, to make sure that we behave ethically. If we all do that, perhaps we'll change the perception of the industry. Perhaps we will safeguard society at large as well. Perhaps we will meet our aspirations to be decent human beings, to be decent professionals, and to be useful to others as well. And I hope whatever you decide to do in your lives and in your professions, that you'll remember the duty that you have to act ethically, and you will continue to learn how to be more ethical as well. So with that, let me thank you for your attention, and hope to meet with you if you have any questions afterwards as well. So thank you.
Thank you very much. I guess we have time for a couple of questions also here, so don't hesitate. I might eventually start with the first one. Yeah. First out of 30. No, don't worry. So it's just one. I know it's late. Nevertheless, I'm actually wondering where you see, for instance, the revenue models in the financial industry in the future. I mean, all the examples you have showing us in a very fascinating and enthusiastic way, also from personal experience, are somehow showing an individual caught in, I would say, in a system where he or she has to make the decision how to behave ethically or eventually also unethically. But somehow we could argue, or at least from your position, that maybe the system or revenue model should be, in a way, not to seduce people in the way you've just shown. I mean, we all know virtue actually comes from resisting seduction, yeah? But maybe the system could be in such a way that the degree of seduction is somehow reduced. So, coming back to my key question, where do you see revenue models should be in the future against the background of what you've just told us?
I hope the revenue models will move in a direction which allows us as an industry to earn a good living without resorting to unethical practices. Now that's easy to say, right? But Warren Buffett said it even better. Warren Buffett once said that what's the point of trying to make a living by being on the sidelines, close to the edge? There is so much money that can be made fairly by being in the center. Move to the center where there are no shadows of ethical issues. So I hope the revenue models move that way as well. I'm hugely optimistic about the financial industry in the long term. I think all of you have a wonderful future potentially ahead of you, despite the image problem we currently have in the financial crisis. I think finance has barely tapped its potential to do good for society at large. There are so many contracts that I would love to buy that I still can't, and I'm convinced that finance will make those contracts available. For example, one of the biggest components in my entire wealth portfolio is my house. London houses are ridiculous prices, as you know. To buy a shoebox costs millions. Well, I can't hedge against that risk. And yet it's the biggest part of my portfolio, the biggest single component. Where are the vehicles, where are the securities that will allow me to hedge against a fall in London house prices? Or what about the fall in the house prices for my street? What about the fall in the house price for my house? Where are the securities and the contracts available to do that? Even more esoterically, what is the worst outcome that I can imagine for myself apart from ill health and death? What's about the worst thing that can happen? Well, perhaps the worst thing that can happen is, I don't know, my wife walking out on me. I enjoy my family. I love them. And if that was to happen, and let's imagine I was divorced, that would be worse than losing my house or losing a lot of my wealth. Can I really hedge against that? Perhaps not. But in between hedging the house and hedging against divorce, there are so many unmet needs still that doesn't allow me to fully express all the views for my financial wealth that I would like to. So there's a huge scope for finance to provide answers to outstanding questions. It will require all of your ingenuity, your IQ, your goodness as well to furnish that. I think finance as a sector of the total economy will continue to grow. But I also said that predicting the long term is easy because that land is always rosy and the sun always shines as well. So a long answer to your question.
Okay, thank you very much. Any further points or questions from your side or comments? Well, anyway, we are
Thank you again.
For some more minutes, and we have the opportunity to work through the rest of my list of questions anyway. So thank you very much. With this, I want to express my gratitude to you, first of all, Nitin, for coming here from London and sharing your views on ethical behavior. I think it was really a great talk, and also, yeah, it encourages us to think of a couple of situations eventually. Most of you, or we have already lived in our lives, and probably some to come as well. And it's also showing that the distinction between ethical and unethical behavior is not necessarily always clear. That you face a couple of dilemmas, and I guess we will reflect what you've just told us, and come back and remember from time to time what we have discussed today. So thank you very much for coming here. Thank you very much, Christian, for organizing that. We very much appreciate that. It's not a matter of course. Thank you also for the other guests coming here from the CFA Institute. We very much appreciate it, of course. My thanks also to you for joining us at this a little bit later time as usual. Nevertheless, I guess it's very good how we developed also the discussions we had. So I hope it was worthwhile for you to come here. Thank you very much for this participation. I wish you a nice evening and see you next week to the regular time again. So So thank you very much.